There is a thing or two I know about taxes. There are 4 tax seasons: spring, summer, fall, and winter. Now that's clear. Let's dive in the truth about government taxes. Taxes are mandatory financial contributions imposed by governments on individuals, businesses, and organizations to fund public services and infrastructure. They are a way for governments to generate revenue and ensure the functioning of society. Taxes support essentials such as education, healthcare, transportation, public safety, and welfare programs. Taxes come in many forms depending on what is being taxed and who is responsible for paying them. As we all know, the government keeps finding ways to separate us from our hard-earned cash. Here are the most common types of government taxation. 1. Income tax. This is a tax on the money you earn through work, investments, or other sources. It can be progressive, higher income, higher tax rate, or flat, same rate for everyone. For individuals employed by a business, this tax is automatically deducted from payroll. 2. Sales tax, applied to goods and services you purchase. The rate can vary by state, county, or city. 3. Property tax, levied on the value of real estate you own, usually by local governments. There are current legislations to reduce or eliminate property taxes in certain states. The homeowner exemption is a property tax benefit designed to lower the annual property tax bill for eligible homeowners on their primary residence. This exemption can save homeowners money on property taxes and is often ongoing as long as they own and reside in the property. 4. Corporate tax, tax on the profits of businesses. 5. Excise tax, charged on specific goods like alcohol, tobacco, or fuel. 6. Payroll tax, taken from an employee's paycheck to fund Social Security and Medicare. 7. Estate tax, charged on the value of an inheritance above a certain threshold. 8. Capital gains tax, tax on profits made from selling investments like stocks or property. 9. Customs duty, tax on goods imported into the country. 10. Luxury tax, applied to high-end goods or services. With so many taxes, it's hard to keep up with due dates. Tax deadlines vary depending on the type of tax and the county or state you are in. Here's an overview for some common taxes in the U.S. 1. Income taxes. Federal income tax returns for individuals are generally due on April 15th each year, unless they fall on a weekend or holiday. In these cases, the due date is the following working day. State income tax deadlines may differ by state. It's always a good idea to double-check with the IRS or your local tax authority, as deadlines can vary or be adjusted. 2. Property taxes. These are usually due annually or semi-annually, depending on local government rules. The exact dates vary by jurisdiction. In most cases, if you are making mortgage payments to the bank lender, property tax will be automatically added to the payment and paid to the city. You only have to worry and pay it yourself when the property is paid in full. 3. Sales taxes. Businesses are responsible for submitting sales tax to the government. The due dates can be monthly, quarterly, or annually, depending on the state and the business's sales volume. 4. Corporate taxes. The deadline for corporations to file federal tax returns is typically March 15th, but extensions may be available. 5. Payroll taxes. Employers must deposit payroll taxes either semi-weekly or monthly and file quarterly payroll tax returns, Form 941, by the last day of the month following the end of the quarter. 6. Estimated taxes. For individuals and businesses that pay quarterly estimated taxes, deadlines are usually April 15th, June 15th, September 15th, and January 15th of the following year. 7. Estate taxes. These are due 9 months after the date of death, though extensions may be requested. Sales taxes are called a nightmare for a reason. Sales taxes are probably the only tax we all must pay, one way or another, unless you never make a purchase. It's basically a percentage of the purchase price. Nexus laws determine the connection between a business and a state that allows the state to impose taxes on the business. Originally, physical presence in the state was needed, such as having an office, warehouse, or employees. However, with e-commerce, online shopping, sales tax is imposed based on volume. An example of that is Amazon. tax is imposed based on shipping address and state of residence. For international purchases, some countries charge taxes like VAT, value-added tax, or customs duties on imported goods, along with sales tax. It's always a good idea to check the tax policies of your country and the seller's location to avoid surprises. Use tax is a tax that complements sales tax and is imposed on items purchased without paying sales tax. Example, you buy out of state or online and don't pay sales tax or pay a lower rate than what your state charges. It's typically the buyer's responsibility to self-report and pay use tax, so be wise and prudent. The end user should be the one paying sales tax. Example is wholesale versus retail. Wholesale sales tax is often not applicable when goods are sold in bulk to a retailer, provided the wholesaler has a resale certificate. Example, the manufacturer's sales to an exclusive distributor, the distributor to the warehouse to Best Buy, and Best Buy to you. You are the only one paying sales tax if you are planning to use it and not resale it to your neighbors. SurTax is part of the sales tax. The consumer may never see it, but it's there. Is an additional tax imposed on top of an existing tax? It is usually applied as a percentage of the base tax and is often used by governments to raise extra revenue for specific purposes, such as funding education, healthcare, or infrastructure projects. In the case of Miami-Dade County, for example, the 1% surtax is added to the 6% Florida state sales tax, making the total sales tax rate 7%. This is why you may see a different sales tax rate when you travel inside the state, from one city to another. You may not escape death, but you may skip sales tax in certain situations, depending on the jurisdiction and specific exemptions. These exemptions vary by state, so it's always best to consult local tax laws for specifics. Here are some common instances where sales tax might not apply. 1. Essential goods. Many states exempt necessities like groceries, prescription medications, and medical equipment from sales tax. 2. Nonprofit organizations. Purchases made by qualifying nonprofit entities may be exempt from sales tax. 3. Resale purchases. If a business buys goods to resell them, these purchases are often exempt from sales tax with a resale certificate. 4. Services. Some states don't tax services. For example, consulting or professional services. 5. Tax-free holidays. Some states offer tax-free shopping periods, usually focused on back-to-school supplies, clothing, or disaster preparedness items. 6. Interstate commerce. Sales tax may not apply to goods purchased online and shipped to another state, depending on nexus laws and volume. 7. Exempt customers. Government entities and tribal organizations may be exempt from sales tax. Native Americans living in reservations, Indians, enjoy several tax exceptions, maybe because we hunt them down and took their land. But the federal government official statement reads, due to the unique legal status of tribal lands. Their tax exception includes property tax exemption. Tribal lands and properties are exempt from property taxes, which can save them millions of dollars annually. Sales tax exemption. Many states exempt Native American tribes from sales tax on goods and services sold on tribal lands. Federal income tax exemption. Tribal members who live and work on reservations are exempt from federal income tax. Also, their casinos are tax-free. These are very popular among people who want to have fun on a tax discount. Remember, play safe and gamble responsibly. Income tax is another daunting topic. State income tax and federal income tax are two separate types of income taxation in the United States, but both are calculated as a percentage of your income. The key difference is who imposes the tax and how the revenue is used. Federal income tax applies nationwide and funds federal initiatives, while state income tax is specific to each state and supports state-level programs. There are 7 states that don't have state income tax, and these are Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, and Wyoming. For the 2024 tax year, there are 5 states with over 10% state income tax rates, and these are District of Columbia, 10.75%, New Jersey, 10.75%, New York, 10.90%, Hawaii, 11%, and California, 13.30%. This could be a good incentive when you choose your state of residence, if you are in a position to make a choice. The mystery of the U.S. tax law. The labyrinth of U.S. tax law, a puzzle wrapped in red tape and dipped in bureaucracy. It's as though the tax code is a living document, growing like a wild vine. The U.S. tax code is massive. The primary law governing taxes is the Internal Revenue Code, IRC, which is part of the federal statutes. However, the tax law expands beyond just the IRC. It includes regulations, rulings, court decisions, and other legal interpretations. The tax law fills dozens of hefty volumes. There are a few reasons for its complexity. 1. History of revisions. The tax code has been amended countless times since its inception. Each change adds layers to the existing structure, making it a tangled web of rules and exceptions. 2. Competing interests. Tax laws are shaped by political compromises, lobbying efforts, and economic goals. This results in a system that tries to balance individual needs, corporate interests, and government revenue. 3. State and federal layers. The U.S. has both federal and state tax laws, which can overlap or conflict. Navigating both systems often feels like solving two puzzles at once. 4. Specialized provisions. Tax laws include provisions for different industries, situations, and demographics, leading to numerous clauses, credits, and deductions. 5. Revenue complexity. As the government finds new ways to raise revenue, they create new tax rules, further complicating the system. Behind all of this, there is Uncle Sam running the show. The IRS, or the Internal Revenue Service, is the federal agency in the United States responsible for collecting taxes and enforcing tax laws. It's part of the Department of the Treasury. The IRS handles various functions, including 1. Processing individual and corporate tax returns. 2. Collecting taxes like income, payroll, and corporate taxes. 3. Issuing refunds to taxpayers who overpaid. 4. Enforcing tax laws and ensuring compliance. They also provide resources and guidance to help taxpayers understand and fulfill their responsibilities. If you're curious, they have a website. Pay them a visit. If you can't fight them, join them. Here is the legal disclosure that our attorneys asked us to make. Unfalsity Media Channel and its representatives are not a tax professional, and we do not provide any type of tax or legal advice. This material is for educational purposes only. We advise and encourage you, resources permitted, to seek professional advice. It's always a good idea to double-check with the IRS or your local tax authority. But fear not, help is on the way, and there is always an app for tax. The IRS provides resources and guidance to help taxpayers understand and fulfill their responsibilities. If you're curious, they have a website. And with this, we are done. Happy tax.